time for an update from the world of business. Welcome to Business Incorporated here on Channels Television. This is what we have for you on the program today. Egypt's headline inflation rises to an all-time high of 36.5% in July. And Kenya retains benchmark interest rates at 10.5%. And in Zimbabwe, the government has intensified crackdown on businesses because of exchange rate disparity. Good afternoon once again. I'm Ini John Mekwa. This is Business Incorporated, and we start off with the market, starting with Africa. We see a recovery there with NGX, that's in Nigeria. Marginal though, but a recovery from that deep fall. It closed to it yesterday, 0.05% in the green, lost to 65,000, now at 64,199.84. In South Africa, they did much better at intraday, 0.96%, almost 1% in the positive. 77,574 right there. Going to other parts in the region, it's 0.09% down for Egypt at 17,747.34. Kenya closed yesterday, Wednesday, in the green, 0.13%, of course, still hovering around 100 index point there, 105. We move over to the Middle East there and see that what the numbers look like is mixed for the Middle East. Abu Dhabi is in the red. There you have it, 0.27%. Dubai follows suit, but drops even further, 0.66% at 4,043.85. Let's look at other parts of the region. There, Saudi Arabia is on the flip side, more than 1% in the green, 1.01% at 11,399.88. Qatar also almost 0.5%, doing well there for those two markets in the Middle East. Let's leave the market just for a little bit and head to Berlin, where we have Chiponda joining us. Chiponda Jimbelu is with DW and TV, joins us from Berlin. And our focus this afternoon with Chiponda is the Italian government that made a slight U-turn, a surprising one, I must add, as a one-time windfall tax on banks. And they say that they will cap the levy to 0.1% of a lender's assets. Well, Chiponda, good afternoon. Thank you for joining us. So why did they take this U-turn at this time?
Well, it was really about the investor response on Tuesday. And now that led the Italian government to walk back slightly on its plan because $10 billion were wiped off the market value of Italian banks on Tuesday after that windfall tax announcement. Now, on Monday, the government had said it was planning a one-time 40% tax on bank earnings. And then it walked back on that decision late Tuesday, saying that it would cap the one-time tax to 0.1% of a lender's assets. Now, that means that Rome will raise less than half of the 4.5 billion euros it would have raised had it stuck to its initial plan. Now, the Italian government wants to use the revenue from the tax to redistribute gains that lenders have been making from higher interest rates when they deposit their money with a European Central Bank. While banks have been making more money from that, they haven't been passing on those gains to savers. So the government wants to use the tax revenue to shore up public finances and also to help mortgage holders who are struggling.
And when we look at this, Chiponda, how do we compare to the moves or the strategy adopted by other countries in Europe?
Well, Italy isn't the first country in Europe to impose a windfall tax on banks. Other EU governments have already done so, and those governments include the Spanish government, the Hungarian government, the Czech government, and the Lithuanian government. All those countries announced windfall taxes in the last 12 months. This is really about the combination of high inflation and high interest rates, and that's piling pressure on European households. Lawmakers are being forced to take action to support citizens who are struggling to cope with high energy and housing costs. Now, across Europe, governments have been saying that banks are not passing on gains from higher interest rates to savers. And while windfall taxes may be a solution that can help raise revenue for governments, experiences in countries like Spain seem to be showing that banks do not change their behavior, or at least they're not willing to do so. Windfall taxes do not make them pass on the gains from high interest rates to savers. Now, in a country like Spain, what we have seen and heard is pretty much banks complain that they are only returning to normal levels of profitability after years of low interest rates in Europe.
And what's going on with the markets?
Well, in terms of the market reaction, they were really, of course, spooked by the decision, which is why we saw that 10 billion euros wiped off the market value of Italian banks on Tuesday. We saw them make some recoveries on Wednesday when the Italian government made a slight U-turn and clarified the tax, that the tax wouldn't exceed 0.1% of bank assets. But for markets going forward, the surprising nature of the Italian government's announcement, it raised an issue about trust and confidence. It's quite clear from the way this announcement was made that there was no consultation with the banking industry in Italy or in Europe. And we know that even the shares of other European banks were affected by the Italian government's decision in Tuesday trading. So if we see more European governments imposing windfall taxes on banks, it could spell trouble for the banking industry across the whole continent.
Yeah, banks are in the face of the storm again. Thank you so much, Ipanda. All right, let's just move close to them there and head to London, where Juliana is standing by. Hi, Juliana. Good to speak with you again today. But this time we have jobs at risk, with Wilco saying they lack emergency investment. There's a whole lot of jobs, I think about 12,000 at risk here.
Yeah, you're absolutely right. Good afternoon, Innie. The breaking news out of London earlier this morning was that PwC, the Big Four accounting giant, has been appointed administrator as Wilco, which was once one of Britain's biggest private firms, has collapsed. And, you know, as you said, this has put 12,000 jobs at risk. They have been in trouble for a series of years, but particularly over the past 6 months, where I believe they borrowed about £40 million and tried to restructure their leadership management team because of the inflationary pressures that are not only affecting businesses, but of course beleaguered households too. But that £40 million loan didn't help. They have been going through extensive consultations. In fact, I believe lots of individuals were interested in buying Wilco because it is so popular. It's been going since 1930. Any of our viewers currently watching us in the UK, Innie, will be familiar with it. It's got very popular branding and sold anything from, you know, tea bags to furniture to kids' toys. But we know consumer confidence in the UK has been very limited because of high inflation, and consumer habits have changed. It's just so much cheaper and easier for people to buy things online. So this morning they did release a statement saying that unfortunately, after trying everything that they could, that they would be going into administration. They had about 400 shops across the UK. I believe just before I got on air, PwC, the accountant, did put out a statement saying that at the moment we're not certain if all 400 shops will be closed, but certainly if you are one of those 12,000 individuals, you'll be very concerned at the moment.
Yeah, of course you'll be concerned, and I think the economy is also concerned. And still another not so good story is, I know you've been talking about issues with NHS and the impact of the strike. Now we see that hospital waiting list tops 7.5 million. That's a lot in England.
Yeah, it's huge. Really alarming details that we've got from the NHS monthly statistics report, which is always released about this time, showing that hospital waiting lists have reached 7.6 million in England. If you cast your mind back to before the pandemic, it was about 4.6 million. And even at that time, NHS bosses said they were in trouble. I think one of the reasons why this news is even more alarming is just because we're at the eve of another junior doctors strike. They'll be striking tomorrow for 4 days, starting at 7 a.m. over the same conditions we've been speaking about over the past 12 months, which is paid jobs and conditions. I know that Steve Barclay, the health minister, has been trying to negotiate with union bosses, but alas, these industrial action does continue. And of course, it's not just impacting doctors who want more money, it's impacting the general public. If you look at that 7.6 million figure, that's 1 in every 7 people. And in fact, since the industrial action from NHS staff has taken place, over 776,000 appointments have been cancelled. And it's very easy to look at that number and just think of it as a statistic. But if we talk about some of the issues and some of the ailments that people are waiting to see a doctor for, you know, these are life and death. People are dying because of these strikes. So this is going to be of serious concern to the Prime Minister, Rishi Sunak. We are close to another general election at the beginning of the year. He did promise, as one of his 5 key pledges, that he would be bringing down hospital waiting list numbers, but the reverse is happening. So 7.6 million people on a waiting list for treatment in England is pretty much abysmal.
Yes, it is. It is. But let's look at the markets and see how that's doing at this time. Not bad, not great at the moment on the UK blue chip index. I think the biggest story out of London today has got to be concerning Entain. They're the gambling owner of Ladbrokes and Coral. They've updated investors this morning saying they've had to put aside about £600 million because they're being investigated about a Turkish subsidiary that they used to own. HMRC is putting them under a serious probe. They've put money aside for that. So I think that's an alarm bell to investors, saying they could be found guilty of some sort of issue. But if we have a closer look at the numbers, the all share is up at intraday by 0.02%, the FTSE 100 down by 0.05%, and the FTSE 250, the domestic market, I believe is up slightly. In the currencies market, the British pound is currently trading up against the US dollar by 0.34%, though it's trading down against the euro by 0.06%. And the British pound at intraday is up against the Japanese yen by 0.49%. All investors are waiting for that important US CPI data, Inni. Yeah, we're all waiting. The crypto market is waiting. Everybody's waiting. Thank you so much, Juliana. Enjoy the rest of your day.
Thank you.
All right, now let's go to Asia, see what's going on there. Markets in Asia Pacific have ended mixed today as investors brace for July. That index we talked about, everybody's waiting for the United States CPI. In Japan, the Nikkei 225 rebounded and climbed 0.84%. Okay, let's see there. We have the Nikkei 225 there, 0.84% at 32,473.65. The Kospi is on the flip side, 0.1%, 2,601.56. Hang Seng index is slightly up, very marginal. That's so risky. Let's look at the other numbers in the region. Shanghai Composite is in the green, 0.31%, 3,254.56. And it's Australia. It's a green market, close green, 0.26% for Australia. We slide over to the United States and can tell you that stock features on Thursday as Wall Street looked ahead. Once again, the CPI is a major factor there. Everyone is waiting for it. Features tied to the Dow Jones Industrial average, we see rose at 0.5%. S&P 500 there, you see 0.53%, 4,509.5. To the Nasdaq, the tech guy, 0.58%, 15,266.25. Many traders on Wall Street are hoping for more signs of disinflation through the CPI report and Friday's producer price index. That's expected tomorrow. Some regional manufacturing numbers have also showed some signs of easing. We move to the global oil space. Prices stabilized on Thursday as investor caution dominated ahead of inflation data expected to offer clues on U.S. interest rate. Brent crude dipped 12 cents, $87.43 a barrel, while U.S. West Texas Intermediate crude edged down 21 cents to $84.19. Both benchmarks have been on a sustained rally since June, with WTI trading at its highest this year on Thursday, and Brent hitting its highest price since January. Oil prices have been boosted in recent times by extensions to output cuts by Saudi Arabia and Russia. Let's take a break now. When we come back, global food prices, we know what's happening to it, but we'll talk about it after the break. Just stay with us. This is Business Incorporated. Welcome back. Still watching Business Incorporated here on Channels Television. At the commodities space now, we look at global food prices, which according to the United Nations have food like rice, vegetable oil. They've risen for the first time in months after Russia pulled out of the Black Sea grain deal. And India now, we know they have that restriction, export ban on rice. That is affecting the price of rice. But let's talk about this now with Victoria Momo, analyst with Financial Derivatives Company. Hi, Victoria. Good afternoon.
Hi, Annie. Good afternoon. Thank you for having me.
Yeah, so from your findings, I know you guys at FDC, you do a lot of research. To what extent will this increase in global food prices, especially the latest one now, which is coming from after the grain deal now, is India, their ban on export of rice. To what extent do we expect it to seep into Nigeria and affect domestic food prices?
Well, it may interest you to note that, no doubt, this, Russia pulling out of the Black Sea grain deal has actually raised concerns of potential food shortage, and this is actually supporting the prices of global food. And then we have India also, placing a ban on export of rice, also supporting the prices of rice to, edge higher. And then for countries like Nigeria, how it affects us or how it filters that into the country is in terms of imported inflation. And this is due to the fact that we are still, heavily reliant on import of these commodities, these affected commodities, in order to meet our domestic demand. And as a result of that, we, would spend, much more money to, import these commodities into the country, and it affects, the domestic prices of the commodity. And then in terms of, the domestic issues, we have the exchange rate problems here, which has caused the Naira at the parallel market to, depreciate to above 933, dollar per Naira per dollar. And this also is, making it expensive for these commodities to be imported into the country. So consider the fact that we import these commodities into the country, it actually would raise the cost of importation, and then this would filter into the domestic prices of the commodity, and then we'd see food inflation also rise. Currently, food inflation is as high as 25.25% as of June, and it is projected to increase further in the coming months.
So we have deflation in China. We know that China is also a major player in both import and export of goods and services. Can we also expect that deflation to seep down into domestic prices?
Yeah, it is true that China actually is experiencing deflation, and commodity prices are falling for the first time in over 2 months, and it is expected that deflation would play a role in the global food prices, would influence the global food prices. And this is because China is actually a major importer of all these commodities, majorly agricultural commodities, into their country. And the fact that there is a deflationary environment, it would actually affect the demand for these commodities, and we could see a potential reduction in import of these commodities. And this is due to the fact that when there is a slowdown in consumer demand, businesses' activities actually slow, and the need for importation also declines. And the fact that China is actually a major player in the global market, it could influence the global food prices of the commodity. And also there is also the export part of the commodities. China also play a role in the export of certain commodities, and considering the fact that these commodities would decline or are declining currently in China, we could also see that lower prices actually flood the global market. And as a result of that, we could see less competitiveness in the global scale, and this could bring down the global prices of commodities.
Yeah, so Victoria, just briefly now, what can I mean, there are so many things Nigeria can do, but do you see us at least using this opportunity maybe to look inwards and replace some of this imported goods to reduce the impact of this deflation and inflation?
I mean, that would really be a good thing for Nigeria to do, considering the fact that prices are currently, rising at the global market. But then again, we also have some, structural issues that actually pose a potential threat to domestic production of certain commodities in the country. Despite the fact that we've had like ban placed on importation, we've had tariffs and the likes, we also have to deal with the structural issues that would basically, boost production here in Nigeria to meet the domestic demand and also make it available for export in the global market. So the key thing here is, despite the fact that the rising global prices actually, present an opportunity for Nigeria, we have to look inward and, solve the structural issues that we're currently facing. So we can actually take advantage of, rising global prices in the coming months or coming term.
Yeah, sounds like a long-term plan, Victoria. But thank you so much, Victoria Momo, analyst with Financial Derivatives Company.
Thank you for having me.
Let's go to Egypt now, where the annual headline inflation rose to an all-time high of 36.5%, and that's in line with analysts' expectations as food prices soared, and that's according to data from the country's statistics agency, CAPMAS. Headline inflation was 35.7% in June, also a record high. Month-on-month prices rose 1.9% in July, and that's down 2.08% in June. The previous high of 32.95% was recorded in July 2017. Food and beverages prices rose by an annual 68.4% in July. Meanwhile, the Central Bank of Egypt expects inflation rates to reach their peak at the second half of 2023, provided that they decline again to the previously announced target, supported by restrictive monetary policy. And still in Kenya now, we move to Kenya, where the Monetary Policy Committee there of the bank there is Central Bank in Kenya has maintained the benchmark interest rate at 10.50% for the second time under the leadership of the new governor, Kamal Thorg. This announcement took place amidst concerns regarding the depreciation of the Kenyan shillings against the US dollar. This decision comes in the wake of several significant economic indicators that have shaped the current monetary policy stance. One of the primary reasons cited by the MPC for maintaining the interest rate is the stability observed in inflation figures. The committee notes that inflation is well within the target range and is expected to further decrease. We're still staying in Kenya as Kenya joins the top league of major avocado exporters in the world, according to figures from the United Nations Food and Agriculture Organization, the FAO. The East African nation is the leading avocado exporter in Africa with a production of 417,000 tons, followed by Ethiopia, which produced 152,000. And just before we go, I will tell you that Democratic Republic of Congo's central bank has more than doubled its benchmark lending rate to 25% from 11% in a move to halt the weakening of the country's currency. A spiraling inflation and a weakening local currency pressure the top copper and cobalt producer. Inflation rate has remained in the double digits territory over the past 2 years, reaching 13.1% at the end of 2022, and that's driven mostly by higher food and energy prices. And Congo brings us to the end of Business Incorporated for today. Thank you so much for being a part of it. I'm Ini John Mekwa. I'll see you tomorrow morning. God's grace, Business Morning, 10 a.m. Let's do it then.